Hi everybody, this is Nicole Vanderstorm. Welcome to the introductory lecture for Module 2. So congratulations on making it this far and getting through Module 1. So by now you should be really comfortable with understanding what your debits and credits are, what your assets, liabilities and equity are, and how your revenue and expenses all intertwine and link with our financial statements, being our income statement, our balance sheets, as well as our statement of retained earnings. Folks, there's one more statement, and that is the cash flow statement. That will be part of Module 3. So folks, what we're doing today is we're just having a quick overview of exactly what Module 2 is going to look like. Module 2 is essentially taking your focus one step further to the principles of GAAP and the other areas of accounting, specifically regarding disclosure and internal controls, which is imperative for you to know to be able to compile financial statements and tell the story for your external users. And who are your external users? Again, it's your creditors and your investors. All right, folks, so what I requested was that you all watch Lecture 1 again. And what's important about Lecture 1 is that there are a lot of principles that I laid the foundation for, which I will be building on in this next lecture and as we go through Module 2. So essentially, with Module 1, we really focused on service organizations, where our main source of income or our only source of income was service revenue for services offered. Also, we didn't really have inventory. The only inventory type of items we were concerning ourselves with was office supplies. And office supplies are not considered inventory because we don't resell it. So if you recall, office supplies, when we bought the office supplies, we would debit the asset, credit bank, and then at the end of the financial period, we'd post an adjusting entry to be able to determine exactly what we had spent. That would be the difference between the opening and the closing stock, and the difference then in turn would be expensed against the income statement. So folks, that is pretty much a revision of what we had to learn that's relevant to this next section. If you recall, in my first video, I introduced you to a company called Nicole's Knickknacks, and essentially I walked you through the operating cycle. We spoke about what we would need to start the business, and then we also spoke about how we would actually operate on a monthly basis in order to churn more revenue and churn more profits and reinvest those and grow the business and so forth, so that we could pay out dividends to our investors as well as meet all of our obligations to both our creditors as well as those folks with whom we generated expenses, and that would be our utilities company, our employees, our landlords, and so on and so forth. So do yourself a favor and go and have a look at that video. So in Module 2, what we will be looking at is we will be looking at the operating cycle again. And if you can see here, let me just pull up my annotation. Pretty much a summary of what we learned in the first module. But firstly, what we do with the operating cycle is we take cash, which is the most liquid asset that we can have, and we turn it into inventory by purchasing it. And then what we do is we sell the inventory, make a profit on it. Then we generate our cash again when we collect our cash from our customers who are in the accounts receivable module. So folks, in essence, this is going to be covered by chapter 5 and 6. This will be covered by chapter 7. And this part, accounts receivable, will be covered in chapter 8. So hopefully now you have an idea of what's ahead on the roadmap. Also, what's important to note is that Module 2 really is having a look at the assets that are part of the operating cycle and really what we would term as being current assets. All right, folks, moving on. please make sure that you go back and watch the introductory video or the lesson 1 video, preferably before we move on to the next piece. So, folks, coming back to our discussion of Enron in the very first introductory class in lesson 1. If you recall, looking back onto the lecture, we discussed the issue of where the auditors had failed. And I mentioned to you that the auditors actually are required to certify 2 things. And the first was that the internal controls are both working and effective. Okay, so the first piece was internal controls. And then the next piece was that the actual amounts were reasonably representative of the financial position as well as the financial performance of the entity. So in this module, we're going to learn more about internal controls. And I really enjoy teaching this section because it really talks to what our role is, not just necessarily as being an accountant who just counts the numbers, but also really adding value to a business. Now, in the past, I've explained, and I think I did this in the first lecture, is that an internal control is a mechanism to protect an asset. Now, a control can consist of a process, it can be a procedure, it can be a specific control which holds custody of an asset. The nitty-gritty of internal controls is that the bottom line is that duties need to be separated in order to prevent fraud. Okay, so what it would consist as a good internal control is where the custody of the asset is separate from those who record the transaction, is separate from those who authorize a transaction. So this is what we would term a good control. Okay, so this control, any good control will ensure that different people are responsible for the different parts of the process. So again, those who have custody of an asset, for example, cash, should not be the person recording the cash, should not be the person authorizing the deposit of the cash. All right, folks? So let's go have a look at our model that we use for internal controls, and the most popular one is the COSO model. Now, COSO stands for the Committee of Sponsoring Organizations of the Tradeway Commission. And if you have a look in my notes, you will see that I've given you some history. But essentially, all of the financial and the corporate responsibility organizations like the ACCT joined forces with other similar organizations, or should I say professional associations, and formed the Committee of Sponsoring Organizations that especially looks at procedures, policies, and systems that can be put in place to prevent fraud. So the COSO model is pretty much, the COSO model is the model that we use, I should call it the COSO framework, is the framework that we use for the purposes of ensuring that internal controls are not only effective, but that they are actually working and in place, and that they actually cover the areas of risk that we identify. All right, so let me just put this onto full screen for you so that I can actually start annotating for you. All right, so folks, this is the COSO framework. I've also given you a screenshot of the COSO framework in the module. There's also a link to the COSO website, some very interesting information there about controls and so forth. And I've also given you an article written by Deloitte, which is one of the big 4 audit companies, on how to implement COSO. So folks, I would like to show you exactly how COSO works. So over here, we have the objectives of the COSO framework. Now, the COSO framework objectives is to ensure that operations and reporting and compliance requirements are met. So these are the objectives of COSO. Okay, of the COSO framework for internal controls. Let me write that a little better for you. Right, so this is the objectives of the COSO framework. Now, as I've explained, as accountants and as financial managers and as folks that are actually in leadership roles in your business, even as a person who does a very task-oriented job, you know, it's really important to think of your role beyond just the case of actually adding columns. The bottom line is that with your internal procedures, you could actually improve processes within a business by ensuring that your internal controls are in place. And that in turn could improve the productivity of the business and the profitability. So try and see this COSO framework or internal controls management as being a specific way to protect the assets of the business, but also as a specific way to improve the way the business operates, okay? Because when you're implementing internal controls, as I will show you, you will see that there are processes that can be made more efficient. For example, there are processes that could be automated. There could be duplicate processes that you're taking out of the system so that you're streamlining them. And there are various ways that you can actually add value to the bottom line of your business implementing internal controls. So these are our objectives of our internal controls, right? Now, you will hear the acronym CRIME quite regularly in your careers. So CRIME just stands, it's just the acronym for these components of internal control, okay? And unfortunately, it's not necessarily in the order of the components in the actual framework, but let me explain each component for you. All right, folks, I just want to draw your attention back to the Enron video and the very first group assignment that I gave you. And I asked you folks to actually consider how was the culture of Enron and how did management actually contribute to a control environment? The question around here is whether management has implemented policies and procedures and whether they are operating effectively. So over here, it's the role of management really and the culture in the business. So we always have a saying in our line of business, and it's really about what is the tone at the top. So if we look at the case of Enron, we saw on our video that there was a situation where some traders had actually been caught being dishonest. And when they were caught for being dishonest, they weren't reprimanded in any way. And in fact, Skilling patted them on the back. And this created a culture of focus on making more money, on the very next financial results, on being reckless. It didn't matter how you did it, as long as you made money. Now, we know that this really isn't an appropriate tone for the top, and that the tone of the top should be one of exercising responsibility and managing towards meeting your fiduciary duties as management, and your fiduciary duties are to your investors. So this is what we mean when we talk about the control environment. Let's go back to the model or the framework. All right, folks, then we have risk assessment. So really, risk assessment goes around identifying items that threaten the business. So let me annotate that for you. So what you're going to do, let's pick a nice color. Let's pick a green. So when we talk about risk assessment, okay, it's going to be pink. What we're really trying to do is we're trying to ID risks that could affect the operations of the business, right? Or risks that threaten the business. All right, so step one, we want to ID the risks that threaten the business. All right. Step two is we need to assess the likelihood, or in our case, the probability of these risks becoming a reality. And then the next step is going to be assigning our maximum loss, or understanding what our potential loss could be. And finally, the next step after that is to act to mitigate those risks. And that in turn, mitigating these risks will tie back to our next step in the model, which is control activities. All right, so let's have a look. What do I mean when I say that we're wanting to identify risks that threaten the business? Well, let's have a look at Nicole's knickknacks. All right, so I know that I am renting a building and my landlord owns the building and I pay an amount of rent every month to my landlord. So there is a risk that the factory could collapse, right? So the question would be, what percentage would you, or what is the likelihood of this risk happening? In other words, the building could collapse. There are many other risks. We could hit by a tornado, we could be robbed, we could have a situation of an injury on the workplace. There are many things that could happen. So I'm going to focus on this one, which is the likelihood of the building collapsing or my factory collapsing. So folks, when we consider this at the end of the day becomes a management decision, and this is based on your expertise as managers. So you would consider items such as how old is the building? Have there been any issues before? Are there any cracks in the walls? Are there any signs of potential of the factory collapsing? So when we look at it, I mean, I would estimate it as a 0.1% chance likelihood of this happening. Okay. All right. Now, the next thing that we need to do, or the next step, is assigning potential loss. All right, so folks, let's have a look at what our potential loss could be if the building collapses. Well, there are a couple of items, right? Let's start thinking about these just broadly. We're looking at damages to the property. In other words, in my case, as the owner of Nicole's Knickknacks, damages to the property would include all my machinery and my inventory being destroyed. But that's the least of our worries. What about the risk of injury and death to our workers? Okay, and then another cost, if my factory building that I'm renting collapses, is going to be, another cost is going to be lost income, right? Because I won't be able to operate and make my knickknacks. Okay, folks. So when we have a look, these are pretty much three big risks that I can think of. When we have a look at these amounts, you can imagine that lost income could add up to millions, because, you know, by then I could be the proud owner of a business that's turning a couple of million in revenue every month, right? Damages to the property, I would have to replace my machinery and equipment that have been damaged, as well as my furniture and fittings and everything else that operates in the factory. And then the biggest thing is, what about injury and death to workers? You know, at the end of the day, it's very difficult to value someone's life. Somebody has once suggested that it could be based on the present value of the person's total earnings and earning potential for the rest of their career. But really, when we're looking at this, you know, these potential costs could add up to millions. So, you know, it's really important that we actually assess the likelihood versus the cost, okay? So we know that the cost here could be millions. All right, so just for my example, I'm going to say my risks or my potential loss maximum is about 10 million. All right, folks. So the next question that comes to mind is, what am I going to do to mitigate these losses? All right. we think there's a 0.1% likelihood of this happening, and that this value could be a maximum of around 10 million, right? So folks, what do we do to mitigate those losses? And this is where control activities come into the picture, because it's various controls that will protect the company and the company's assets and will reduce the impact of risks to the business. Okay, so we could mitigate. Okay, so when I say we could mitigate, we would take steps to reduce the risk. We could also, if we needed to, we could also decide that, oh, you know, the risk is only 0.1% of it happening. So, you know what, I'm just going to ignore, I'm just going to accept the risk. And when I accept the risk, I say, okay, I'm going to put aside a little bit of money, and if this happens, then we deal with it then. Or we could mitigate the risk by insuring. We could transfer the risk. And the way that we would transfer the risk is by an insurance policy. Okay, and basically what this means is that we pay a premium every month to our insurance company that in the event of something like this happening, they will bear the costs in return for a monthly premium that we pay. And this monthly premium that the insurance company calculates is actually based on the likelihood, all right, the probability of these risks and the value of potential loss. So at the end of the day, what you're doing is you're paying a premium, which is calculated by actuaries who are really good at determining probability and risks. All right, folks, so how do we mitigate these risks? Well, that's where our control activities come into play. Right, folks, I've just put up a new screen for you, a new screen share. And what you will see here is that I've cleared out our text, and we're going to talk about control activities. So if we have a look here at control activities, folks, the definition of a control activity, it's really a question around, are there sufficient controls in place to mitigate these risks? Okay, are they sufficient? In other words, will they protect the business from risks? Okay. Also, are they operating effectively over a period of time? Okay. And when I say over a period of time, when auditors come along, they actually audit your annual financial statements. So the question is, when auditors come to audit our internal controls, is they'll be looking at how they've operated over the last year. You, however, as the accountant or managers within a business environment, will be looking at how they operate perpetually, right, on an ongoing basis. And essentially, controls are tested by auditors who will attest that the statement by management that the controls are in place and operating effectively is a reasonably fair statement to make based on the evidence the auditors collect. All right, folks, so first things first is, do we have existing controls? Okay, if not, your role working in the environment is going to be to put those controls in place and make sure that they are running. So when you put controls in place, you know, the real critical question is centered around your information and communication that you actually provide to staff members. Right, so when we talk about information and communication, folks, we're really looking at communication to both internal and external users. Okay, so The question is, do the staff understand what their roles and responsibilities are? Do they know what their requirements are, what is required of them? And have they acknowledged that they understand what their requirements are? So the first question is know and acknowledge. Okay, so one example of this is the Code of Ethics. Many businesses have a Code of Ethics, and every single year you are required to sign this Code of Ethics and confirm that you will comply with it, that you understand it, and that you acknowledge having read it. Okay, folks. Another important component of information and communications is how we actually distribute the information to the users, both internal and external. So really, the requirements is that we need appropriate information, okay? So it needs to be appropriate, timely, available, accurate, and accessible. So when we talk about communications, the question will be, well, so we have policies. Do the policies cover the entirety of the subject? Are they available? Well, normally they get put up on the internet, or alternatively, they are distributed and folks are required to electronically sign an acknowledgement. Whether it's accurate, these policies should be kept up to date. And policies, again, will determine your procedures and your systems that you will use for your procedures. And accessible and available pretty much means that folks can access it when they need it and use it in the day-to-day operations as a guide to what needs to be done. All right, folks, and then the last piece of the COSO framework is this piece, which is called monitoring of activities. Now, folks, I'm just going to clear my notes. Now, what's really important to understand here about monitoring of activities is that it really talks to performance management, right? So if you have, and when you do have, internal controls throughout the business, you will make compliance with those internal controls part of people's job descriptions. And not only will they be required to perform these internal controls as part of their job descriptions, but you will require a certain standard of compliance, right? So as an example, a cashier, you would require, for example, that she is never over or under by more than $30 over a period of time. And then what you would do is at the end of the year, when you're discussing raises and performance reviews, you would have a look at that and take that into consideration, right? Have they met the requirement that they are not going to be more than $30 at an over or an under? So really, the purpose of a performance management system is to notify, okay? It's to identify. So it's to notify folks of identification of things that are and are not working, so of controls that are and are not working. All right, and then also it's going to be really about correcting these, okay? So when it comes to monitoring, with our performance system, we will reward people for compliance with bonuses and so on, and then we will punish those folks who don't comply with warning letters or less of a bonus, and we will have to work to correct any issues that are found. Okay, folks, and then the scope of the COSO framework, you know, this part of the cube really just illustrates that internal controls should run through entity level, division level, operating unit level, and functional unit level. In other words, internal controls and the culture of protecting your business from threats or responding to threats in an appropriate manner should be throughout the business. The culture of internal controls should be something that is pervasive, it's part of everyday processes, and it's part of the management ethos. So this is really an important component. So folks, let's have a look at how we would apply a COSO model, or how we would apply internal controls in an organization. So what I want to do is I'm going to select two parts of the operating cycle. The two parts that we're going to look at, I will do inventory, cash, and receivables. And let's have a look at those components of the operating cycle, and let's see what kind of controls we would put in place in those components of the operating cycle to ensure that we are protecting the company and mitigating from potential threats and potential risks. All right, so I'm going to use a whiteboard right now. And I just want to be sure that I've pulled up the right items. So give me a moment to set up. Okay, folks. So if you recall, in our very first module, I think this is chapter 2 or chapter 3. And what was illustrated to us is that transactions occur in the business. All right, we analyze them. And then what we do is we post them. But really, our analysis is going to be mostly based on source documentation. So step 1 is that the transaction occurs. As the transaction is occurring, it's being documented. Okay. Let me just give you a new share. All right, folks. So just going back to this. So when we look at the screen, okay, we're looking at our transactions as they occur. Source documents are prepared because they're proof of that. And so, okay, so transactions will occur. Okay, source documents are prepared as proof of that. Then these transactions are analyzed, and then they're journalized and posted. Okay, so folks, the piece of that is driven by internal controls is really going to be focused around your source documents that are prepared. Okay, so let's go have a look at this again. So like I said, transactions will occur, source documents are prepared, they're analyzed, and then they're journalized and processed. Okay, let's go back to our internal controls. Have a look here. Source documents are prepared. Okay, so this is going to be the guy in control of the assets, preparing the source documents. Okay, the person analyzing and posting these transactions is going to be the reporter. And then, of course, we're going to have an authorization process for various parts of the operating cycle. All right, so how does this work in our environment? Well, let's have a quick look. Now, folks, what I just want you to understand is that this is a very basic approach. This does not make up for the detailed lectures by Professor J. Simpson. Those are linked in your modules. So this is just to give you an overview of what we're doing and how internal controls apply to the different components of the operating cycle. All right, folks. So if we have a look at our internal controls, as I've already explained to you, the person that's in custody of the asset should not be the person recording the asset, should not be the person authorizing the asset. So let's go back to our internal controls. I'm just going to clear this whiteboard up. Let's clear it up. And let's go look at our very first example. So let's talk about inventory, right? The very first step in the cycle, we're going to buy inventory, okay? So let's have a look at the steps. So the very first thing that's going to happen is that we're going to order stock, right? We want the stock. The next step that's going to happen is this, sorry, I'm going to say we're going to order inventory because where I come from, we call it stock, and that's actually not the correct wording. So I'm just going to clear this. All right, so what we're going to do is we're going to order inventory. All right, that'll be our first step. Our second step is we're going to receive the inventory. All right, our third step is we're going to use the inventory. All right, or we're going to sell the inventory. Okay, if you guys do management accounting, which is accounting module 2, you will learn about how we use inventory in the process of manufacturing and production, how we cost that. So our focus will be we sell the inventory, and then once we sell the inventory, the next piece of the operating cycle is that we are going to pay for the inventory. All right, folks, so let's have a look. How would we, perhaps the first question would be, how would we have a control in place to tell us when to order inventory? Okay, so the first question that's going to come to our mind is, hey, when do we need to order inventory? Now, there are a couple of ways. Somebody could keep track and say, hey, we got this job, we need to get this inventory. So it can be a manual process, or it could be an automated control, okay, where your stock system basically tells you, hey, you need to order more stock, or you need to order more inventory, sorry, right? So first things first is, when do we need to order, okay? So the reason why we would want to control here in the when do we need to order step is because we want to be sure that we're not overstocking on inventory. Because as you folks know, that you were taught in module 1, is that the longer we hold on to inventory, the more it costs us, right? So what we're wanting to do is wanting to turn over our inventory as fast as possible. Okay, folks? So the first question is going to be, when do we order inventory? So we're going to have a control for that. All right. The next question is, how much should we order? Okay, which is really going to be the same here. So when do we order? How much do we order? All right. So folks, we could have a control here that automatically triggers, hey, we need to get these items ordered. But when it comes to how much, it really depends on how the business is run. But it could be a case of somebody has to go and source a supplier, somebody has to negotiate prices, or alternatively, it could just be a case of, well, we've run out of the stock, or we're reaching critical low levels. We need to just replenish our stock with our same supplier. But in order to do that, we actually have to issue documentation that proves or that actually facilitates this process. And what we call this document is a purchase order. Okay, and what the purchase order tells is how much of a certain item we need, which is, so a purchase order is going to talk about quantity, cost per unit, and other items, okay? And then also what's important is to have a control in place here that somebody needs to authorize the purchase order before it gets released, okay? And more often than not, it'll be a manager that needs to release the purchase order before it gets printed. So it needs to be authorized and checked for accuracy. Because again, the minute you have someone actually manually intervening in a process, you have a risk of a mistake being made. So you would want a person to authorize and check the accuracy of the order. So as you see, just from the ordering inventory step, we have pretty much 3 controls that tells us when we need to order, how much do we order, and authorization of the issuance of the purchase order. Okay, folks? So that's what the control would look like in this step. All right, we received the inventory. Okay, so one important point here is that when we receive the inventory, somebody has to check it, right? So what's going to happen is that somebody checks and counts. So somebody checks quantity, and that somebody is normally the person accepting deliveries. Okay, so we'll call him the storeman. Okay, and he will check that the items match what it said on the delivery note. Okay, so we would get what we would call a delivery note from the supplier. Now, a delivery note here is not necessarily going to tell us anything else except quantity. Okay, so the delivery note is going to say, I delivered X quantity to you on this date. Okay, and the purpose of the storeman is that he is going to put a control in place and he is going to check the goods. He's going to make sure that they're not broken. Okay, he's going to make sure that the amount ordered is what has arrived, or the amount on the document is what has arrived. So he will check for quality and quantity. So that's our first control. Okay. All right, so he's going to check the quality and the quantity of the goods that have been delivered. Okay, now folks, there's a second piece to this process, all right? So we get a delivery note from the supplier. Okay, the supplier tells us, I am delivering this to you. We in turn bring the inventory in, okay, and we use or we issue what we call a goods received note, a GRN, or a goods received voucher. Okay, so we're going to issue a goods received note. Which will confirm to the supplier that, yes, we have actually received these items. Okay, so that's the purpose of a goods received note. So you really want your delivery note, your goods received note to match. And this goods received note is normally printed when you check the stock into inventory. Okay, so we would have a control here when the storeman checks the stock into inventory that he's checking in the right quantities. Okay, then one more control that's sitting here that we don't think about is a very important control, and that's the fact that everything is put under lock and key. Okay, so what will happen is it gets put in the storage room and it would get locked. So acid is under lock and key, being inventory. So the acid is secured. Okay, I hope this makes sense to you folks. So that's where we would put controls in this step of the process. What about paying for the inventory? Well, folks, first things first. We've brought in the inventory, we've ordered the inventory, we've brought the inventory in, we now have the inventory in our storeroom. We have the documentation proving these processes, which is part of internal controls. Okay, so we have the stock, the inventory in custody. We have these documents that are recording the transactions. So I'm just going to say, put a little R here for those that are reporting. All right, so there's a recordal of the transaction. Here's a recordal of the transaction, the delivery note. Here's a recordal, which is the goods received note. These normally happen together, okay? And finally, the question becomes, well, now it's time to pay. So after this step of receiving the inventory is done, we use the inventory and we sell the inventory, but also we would have to pay for the inventory. Now, the first control in the payment process is going to be that the supplier will issue us an invoice. So let's choose a fun color here. All right, so first things first is the supplier will issue us an invoice. Okay, now when the supplier issues the invoice, all right, it will get delivered to us either by mail, and the invoice is going to tell us a whole bunch of things. And the most important things that it needs to tell us is what quantity they're invoicing us, okay, quantity, what amount they're invoicing us, and also what the payment terms are. All right, so amount and payment terms. Now, folks, for those of you who don't know, is that sometimes suppliers will give you a discount for paying the invoices quickly, and they do this as an incentive to speed up the cash flow. Okay, now what we would do is we would have the person who is responsible for recording this transaction. Okay, and this will be the recorder. So the recorder will come along. Okay, remember, we have the guy in custody. So the storeman is the custodian. All right, and then we have the recorder. Apologies, I'm not really. Let's see. Let's just erase this little thing. Okay. All right, folks. So then we have a recorder. Now, who would the recorder be? Guys, the recorder is going to be someone in the accounting department, right? All right, the accounting department or a bookkeeper, somebody is going to record this. And the first thing they're going to do is they're going to perform a three-way check. All right, so let's draw another little person here so that you remember. So there's our recorder. Let's do this again. All right, so our recorder is going to be another person. With big hair, okay? And this person will record it. And it's normally the bookkeeper or somebody in accounts. Okay. Now, what the recorder will do, normally in this case, it would be a creditor's clerk when it comes to this side of the business, because a creditor's clerk would be responsible for recording these transactions and making sure the documentation was correct. So the first thing they would do is perform a three-way check. Now, when I talk about a three-way check, okay, so control one is going to be a three-way check. They're going to check that the invoice matches the purchase order matches the delivery note, okay, which was signed for, matches the invoice that's been received. So you see, this is a three-way check. So when we talk about this, a three-way check, basically what the recorder is responsible for doing is bringing together all of these steps and documenting them, okay? And the way we would document it is we would develop a remittance advice, and we would then put together this documentation, which will give us the three-way check for these items, okay, that they all agree, right? Then from there, the bookkeeper is going to go to the authorizer and request payment, okay? Let's make this pink so we know it's another person. So they will go to the authorizer and request payment. Now, the authorizer can be the person signing the checks. It can be the person that releases any EFTs that are done. And also the authorizer will check as well. So you see here we have an authorizer before the purchase order is issued. And here we have an authorizer before payment is made. So you see, these are very many controls that cover these steps in the process to make sure that we protect the business from risk of mistakes, incorrect quantities being delivered, poor quality goods being delivered, as well as incorrect payments being made. Okay, folks, so that's the example of how an internal control would work in the inventory part of the operating cycle of a merchandiser. In other words, a merchandiser being someone who deals with inventory. Okay, folks. So take a screenshot of this. Okay. Let's have another look. Let's have another example. Okay. Now on the sales side, obviously that would just be a flip of this process that would apply to the suppliers, just that the roles would be reversed. So it would be very similar, just that the roles are reversed. Now, let's have a look at cash. Okay, cash is one of the components of the operating cycle that I showed you earlier on. Okay. And what I did give you an example of in the first lecture was the example of a cashier at a store, and what the controls would be that would protect the store from losing money at the till point. So what would happen is the cashier would give a receipt to the person paying, and that in turn will be confirmation to that person that we have received that amount. And then in turn, the cashier will have to make sure that the amount in the cash box matches the amount of transactions on the sales for the day. And then also, what will be required is that someone will have to come and record that amount and actually make sure that the cash that was deposited was actually received by the bank, which would be a bank reconciliation. All right, folks, so let's talk about receipt of cash as an example. Okay, so let's see. So the first thing we're going to do is we're going to receive cash. Okay, the second step will be match cash to, we'd receive the cash, right? The next step would be take custody of the cash. All right. And the next step would be deposit the cash. All right, folks. So let's do it from here. This is just an example, right? So I'm receiving the cash. All right. So when I receive the cash, the documentation that I am generating is going to be a receipt. All right, a receipt to prove that I have received said cash from you. Now, what's important to bear in mind is that every time a receipt is generated, it also records the transaction. Okay, and that can be automatic in a lot of cases because we have a point of sale terminal in the business, right? So the recordal of the transaction automatically happen with the receipt. Okay, then the asset will be secured. So the cash will be secured in one of two ways. Firstly, okay, she will take custody of the cash. She will put the cash safely in the till drawer. Okay, so custody, safety in the till drawer. And as you folks know, when it comes to a till drawer, you can't access it unless you use a specific code, for example, or if you're the person that has the keys. Okay. Another way that we put in a control for custody purposes is a lot of times what we do is we keep the float very low. So we keep money as low as possible in the till, right? And how do we do that? Well, we send the money to the bank. And a lot of times what we do is we use a drop box. Now, when I say a drop box, it's basically a safe that we don't have a key to, that only the bank has a key to. So you put large amounts of cash into that, and the bank in turn comes and collects that cash and takes it straight, or I would say the transport company collects the cash and then takes it straight to the bank. Okay, so we're going to keep the money safely in the till drawer, and we're going to keep the money as low as possible, right? So we would put the money in the drop box. And the reason why we would do this, well, we're protecting from theft, right? So we're mitigating the risk of theft. Let's type this thing for you. Okay, so if theft does happen and somebody does get into that till point, you would want to be sure that the amount that's going to be stolen is going to be as little as possible if they get past your cashier. Okay, and the third step, as I already mentioned, is that we don't have anybody having to go and deposit the money. We use the bank to do it, okay, or we use a transport company. So we're mitigating as well. We're mitigating the risk of somebody having to actually go to the bank, okay? We're mitigating the risk of a lot of cash being stolen if there's a mugging, for example. And then we're also mitigating the risk that the items would be stolen by somebody who is in transit, because we use a very special lock safe and only certain people or have the key or the combination. And a lot of times what happens is that with the lock, with the drop safe, you actually clip out a locked deposit box that you don't have the key to. Only those folks at the bank who actually process the deposit are the ones that have the key to the drop box, okay? So bank staff have the key. So bank staff then take the deposit. Okay, that's all good and dandy. So we've covered custody, we've covered recordal there. But now, what about the deposit of the cash? So the first thing, folks, is that when cash is deposited, okay, it's going to show up on our bank statement. Okay, and essentially the bank statement is telling us, look, we received these deposits, and what we do is we actually reconcile the bank statements. So I'm going to say this is a recording and checking. Okay, so the bank statement is a recordal. And then we also know about these transactions because, of course, we've got our general ledger. And every time that we've received money, we've issued a receipt, right? So we know that we have the amounts per the general ledger. We also know that every day all of these transactions are added up, and we make sure that the cash in the till matches the transactions. Okay, so we do a cash reconciliation at the end of every day, or a cash up. That's what we call it in the business. Okay, so at the end of the day, we'll do the cash up. where we make sure that all cash per the transaction rule okay, so on a daily basis, we're doing an end of day cash up. And what we're doing here is we're checking, all right, that every single thing is accounted for. Okay? All right. So back to our issue. So we have a control there, but we also have a control here, making sure that the money actually gets to the bank and is deposited here. And what we do is we do a reconciliation, which is really we compare the amounts and we look at the differences. Okay, so we do a bank reconciliation. Now, normally the bank reconciliation is done by someone senior, who we call an authorizer, because it's not going to be done by the recorder. Okay, it's not going to be done by the bookkeeper who's accounted for the deposits and the transactions. It's going to be an authorizer. Somebody senior will come along and check what the recorders have put in the general ledger and will make sure that it ties to the bank reconciliation. All right, folks. So again, when it comes to cash, it's just a general overview of what the internal controls would look like. And essentially what we're talking about is we're talking about they would be receiving cash, they would be recording the cash, they would be taking custody of the cash, they would be checking the cash on a daily basis or even more regularly when they close the till point and drop money in the drop safe. Okay, then another control would be to transport the cash safely to the bank. Bank staff take the deposit, so that eliminates the risk of the transporter committing theft. It eliminates the risk of folks being mugged on the way to the bank. And then the bank staff record the transaction on the bank statement, right? So they're also a recorder. And then the authorizer is the guy who comes along, or the girl, who comes along and reconciles the amounts per the bank statement against the general ledger to make sure that everything is accounted for. All right, folks, so that would be a control for cash. All right, so now we've done two pieces of the operating cycle. All right, so the third piece that I would like to use as an example is going to be, give me a second. It's going to be receivables, right? So folks, when it comes to receivables, remember the sale is going to be recorded exactly the same way as we record a process, but I mean, exactly the same way we record the purchase of inventory, but it's just going to be the opposite way. All right, so for example, when we release the inventory, we will have an inventory release note. We will have a delivery note for our customer. We will also issue an invoice to our customer, and they will do the three-way check, right? And then when they pay us, what they send to us, when a customer pays us, so we're going to say customer pays us because we're busy collecting the items. Now, when the customer pays us, they give us a check plus a remittance advice. Now, basically, this is the transaction supporting, or the documentation that supports what the amount was that was issued to us. Now, folks, what we must bear in mind is that it's not necessarily just purchases that happen during the operating cycle, right? Sometimes purchases can be returned, and sometimes we would reduce the cost of our inventory simply by the benefit of having a discount for early settlement. So let's bear that in mind. So the remittance advice doesn't just talk to what they should be paying, it talks to what they actually are paying. So you would come along as a debtor's clerk, okay? So then the debtor's clerk, who is the recorder, okay, the debtor's clerk. Remember, the recorder for the creditor side is called a creditor's clerk, right? So the debtor's clerk would come along and would check the check amounts against the invoices that are paid, right? So they would document receipt against invoices, or let's say against the transactions for the month. Okay, now what's important though is to bear in mind that custody is a completely separate process. Okay. What happens is that somebody else will deposit the checks. Okay. All right. So it's not necessarily going to be the debtor's clerk that does a bank deposit. The person that would probably draw up the bank deposit would probably be the bookkeeper or the cash clerk or even the accountant. Now, why would we do that? Well, the reason why we would do that is we would ensure that what the transaction roll says by the recorder ties back to what our bank account says, and it goes back to what I earlier explained, which was that somebody senior would come along, the authorizer would come along and conduct a bank reconciliation. Right, folks, so you see how internal controls work? It's always about the recorder, should be separate from the custodian, should be separate from the authorizer. All right, folks, so that's pretty much what COSO is about and what internal controls are about. Please take time to review this because these internal control skills are something that will be tested extensively going forward for the next exam. You will be asked to determine whether an internal control is appropriate or not, and you will be asked to design internal controls for the three processes within, or the three pieces within the operating cycle of the merchandiser, which again is going to be the cash piece, the inventory piece, as well as the receivables piece. All right, folks, I'll see you in the next lecture when we talk about Chapter 5, which is merchandising inventory. And thereafter, we will have a video on Chapter 6, which is really talking to how we actually cost the value of the inventory in our balance sheets. All right, folks, let's get to it. I hope you have a great day ahead of you. And as always, you know where to find me if you have questions. Thanks a lot, everybody. Take care, everybody.